Hi everyone, my name is Christy and I'm a senior writer here with Deal Street Asia, your go-to platform for all things private equity and venture capital in Southeast Asia, India, and Greater China. So we're discussing a topic that's very hotly debated and all the rage in our industry today, and that is the Special Purpose Acquisition Company, or better known as the SPAC. There are a few subtopics that I'm going to broadly cover today. I will try my best to cover all of them. First is the role that SPACs play in the PE and VC market. Second is how deal quality in Southeast Asia fares against other ecosystems like China, India, the US. Third, what are some potential challenges one may face when executing a SPAC? And the last is, should Asian exchanges allow SPAC listings? So today's discussion is going to be an hour long. We're going to set about 15 minutes at the end of the panel for some Q&A where you can submit your questions in the chat box over there. So if you do have a burning question for any of my fellow panelists, please leave your name, your company, and your question in a comment section in Zoom. I'm sure you guys are quite familiar with Zoom by now. So to start today's panel, I'm going to introduce my three panelists. First off, we have Mr. Ravi Thakran, who is former managing partner at L Catterton, as well as chairman and CEO of Aspirational Consumer Lifestyle Corp 1 and 2. So he has two. And recently announced the merger actually with Wheels Up for your first SPAC. Congratulations on that. Second, in line we have Helen Wong, I think very familiar face to many of us, partner at Qiming Venture Partners and is also an investment advisory board member with Catcha Investment Group. And last of all, we have Jun Hong Keng, who is founder and CIO at Crescent Cove Advisors. Based in Silicon Valley, so he joins us from SF right now. And his SPAC, he's also leading the Cove SPAC, also their first SPAC at 300 million. Yeah. So a very warm welcome to everybody. Thank you for joining us here today. So I'm going to kick off today's discussion with a question for you, Jun. I mean, how much, I'm not going to delve into the details of, what exactly a SPAC is. I'm assuming all of you guys are our viewers know what exactly a SPAC is. First question to June. I mean, how much of your decision to launch a SPAC was, a bit of FOMO? We've seen so much excitement, so much buzz in the market today. Everyone seems to be launching a SPAC. Everyone from a Hollywood celebrity to a sports, to a sports star, to venture capitalists, to PE funds. Do you think this was a bit of FOMO in your case?
Christy, thanks for the question and thanks for the invite for being on the panel. Great question. I think it will be helpful to give a brief background on Crescent Cove and how we fit in the landscape. So we are a TMT investment firm based in San Francisco, founded in 2016. We have a strong team and a strong investing track record. On the SPAC side, I've been familiar with SPAC since 2005, and we view it as a flexible financing vehicle for middle market companies, especially within the TMT high growth space. And in 2020, in December, one of our portfolio companies, Lumina Technologies, completed its business combination of a SPAC, and we were intimately involved in the process. All in all, through that experience and the greater acceptance as a financing vehicle for companies in the past 12 months, which of course could ultimately lead to a potentially larger pool of high quality companies, made us believe that the COVA team and Crescent Cove can help make a difference, led to our decision to launch a SPAC.
So how have things changed? I mean, you said that you first got involved with a SPAC in 2005. It's 2021. Have things really changed for the SPAC vehicle?
The SPAC vehicle, actually, there have been small tweaks to the structure, but all in all, it has been quite consistent on the kind of overall structure.
So, I mean, so that then, you know, we get back down to the question again. I mean, when it comes to, I mean, how much FOMO is this, you know, for someone like like yourself, you know, we've seen so many specs enter the scene recently.
Yeah, I think part of it is, you know, it's really not a question of supply. I think the acceptance, having more companies being open to being acquired by a SPAC or being listed by a SPAC, really created a rush for more sponsors to come out with SPACs. Right? If it's not acceptable as you know, if you don't have high quality companies that do not want to be acquired by a SPAC, then of course you will not have that many sponsors trying to raise a SPAC. Does it make sense?
Yeah. Maybe you can go to Helen. I mean, like, what led to your decision to launch a SPAC, and why?
Sorry, I didn't launch a SPAC. I am just an advisor to the Catcha SPAC. So I just to give some background. So I am a VC, and so when I heard about SPACs, it was something that, you know, intrigued me because it seems like more and more companies, especially in the technology space, were using SPACs to go public as an alternative to an IPO. So when Patrick at Catcha approached me to be an advisor, I thought it was you know, an interesting vehicle that I should learn about. So that's why I, you know, and also given Patrick's background, given the Catcha team's background, I felt that, you know, they could do a good job to help Southeast Asian companies go public. And I actually think SPACs could be very interesting for Southeast Asia, maybe more so than other regions, because there has been so few IPOs. And so actually having a sponsor to lend credibility to the Southeast Asian teams, management teams, as they seek an IPO listing, you know, could be a very good plus for these companies.
Yeah, but we've seen so many SPACs enter the market, I mean, in the last 6 to 12 months. I mean, I don't know. Well, I mean, there are two questions. I mean, first is, I mean, do you think the SPAC market is getting a bit overcrowded? And second of all, what does this mean for a Southeast Asian SPAC? How are you going to differentiate yourself compared to there's so many US SPACs that you see out there in the market who have people on their boards who are, you know, way more experienced and have even done SPACs in the past?
I think so. First of all, for me, from my perspective, the number of SPACs that are coming out is not the most important matrix to watch, because I think the reason the rise of the SPACs is really because of the free flow of money. So there is negative interest rates, there is very low yield. So there's a lot of money looking for good assets. So that means that there's a lot of money that will be parked into SPACs, and especially, you know, remembering that SPACs are a good way to have low, you know, downside and, you know, potential upside returns. So it's a pretty, you know, good vehicle to park your money. But actually, I think the important matrix to track is actually the de-SPACing. How many of these SPACs actually will be successful, you know, mergers and successful IPOs for, you know, tech companies. So to me, that is the more important matrix. You know, are there too many SPACs? I think that it's very, you know, it's a very big question. I think that as long as, you know, there are good targets, it's just like the IPO market, right? As it goes through cycles. As long as there's good quality companies coming to the SPAC market, I think there will be a continuous, you know, supply of SPACs and demand for SPACs. And as long as the quality deteriorates, then, you know, maybe at some point, people will be less enthusiastic about SPACs.
Yeah. But you see, the problem is, you know, when you talk about the de-SPAC process, you know, people tend to quote the historical track record for SPACs, which is, you know, you do see a substantial percentage of SPACs liquidating, not being able to find targets in the end, because, you know, only a couple of them are able to get the top-notch targets, which everybody reads about in the headlines, right? I mean, like, Ravi, I don't know if you can actually take this question. I mean, how much did that factor? I mean, you recently did an acquisition with Wheels Up. If you could kind of take us through that process of, finding the de-SPAC, finding the acquisition and de-SPAC process. I mean, what was that like for you? Because you did it pretty quickly.
Look, first of all, it is very natural to have this focus on the number of issuances in the market. Because SPAC issuances have been unprecedented. It's been incredible number which has come to the market, and it certainly cannot continue at this level. There'll be some correction. So I can say there'll be many one and done kind of guys who would either raise and never find a target or find first and that's it. But at the same time, I think there'll be many franchises which will build a very high quality franchise and come back with repeat transactions and bring very good outcomes. And I think the key issue there is the quality of the sponsor. Now, when we met investors as well as the founders and CEO, there was one common thing as a feedback from both. And then, by the way, McKinsey did a study which came out in September last year, which says that there is a single variable that stands out between good SPACs and not so good SPACs, which is the quality of the sponsor group and their operator's edge. Now, people who have operator's edge, who know the business well, who can add value to the business, those SPACs do 40% better than the normal. They even do 10% better than the index. That's as per McKinsey report. So I would say, yes, there is always a race to get on the bandwagon, but the key issue is the quality of sponsor, quality of targets they seek, and again, sincerity of purpose in it, this one that they're really there to add value to that play. So look, we always believed in that when we're going out for a SPAC target, you need to go for a brand that resonates. It is in a category that has true tailwind. It is IPO ready. It is strong growth, but can be accelerated further with partnership with people like us. And there is strong unit economics, or there is a clear path to profitability. If these aspects are clear, I think certainly market would welcome. And this is how we were able to find, our play was very focused, consumer, and that too aspirational consumption. So aspirational consumer lifestyle, our name itself is reflective of what we were after. We were looking at many things in fitness, wellness, hospitality, even spirits. But once we found Wheels Up, it ticked all the boxes on a business that is very differentiated. Business wherein, in private aviation, there has been a lot of, let's say, a filter in the past which didn't allow people to go and use. For example, according to another study, 91% of people in America who can use private jets, who can afford to have to use, but never flown private jets. On the other hand, private jets are sitting idle for 95% of the time. So here is a new generation tech platform, which is now connecting the two. Millions of customers one side and tens of thousands of aircraft, and it created an Uber of skies. So we felt it was a perfect asset to go after, and we could add a lot of value because the customers of private aviation have 100% overlap with customers in luxury goods, where we have very deep experience, and we could connect the two. Hence, success.
But a lot of these targets are already, companies that are pretty matured. They've been around for a long time. Founder has built this thing from the ground up. They have a solid leadership team. What kind of value does a sponsor actually bring to these companies?
Well, look, there are two clear aspects about it. One, in our case, there were two things. One, our team, my colleague Mark Bedingham, who built Moy Hennessy for the last 20 years, my other colleague Lisa Myers, who invested for 20 years in public markets and consumer, we could bring two faculties. One, that if you have a brand which is already doing well in Americas, but you want to make it a truly world-class brand, this is what we have done. We've done whether taking Dior from being a European brand to global brand, or taking Berluti from a small Italian brand to a global brand, to many other brand stories. So we could really add value to that in building a world-class brand. But second, very important piece for some of these businesses is a bridge to Asia. You might be doing very well in America or Europe, but if you have not penetrated the highest growth market in the world today, I believe 60% plus of GDP growth of the world will come from Asia going forward. Now, if you have not built a right bridge to it, you would therefore not be truly global brand. We, having done that for a long time, could provide that bridge too. And look, overall, the share you get at ultimate listing is in small single digit. Our value add gets paid out in sometimes in a few minutes of the stock trading itself. So people sometimes are focused too much on I think If you're focused, you're staying true to your stitching, you are in the segment that you know very well, I think those SPACs will do very well.
But don't you think these are the same things that a lot of venture capitalists or even PE funds will say that they can offer to some of these target companies, access to new markets, access to their network, these are things that, what difference will it make, apart from taking venture capital money?
No,
Ravi or June can take this.
Go ahead.
Well, Ravi makes a lot of good point, and Christy, that's a good question. I think sometimes the value add for a management is important, right? But the partnership, it really gives the management who's trying to go public the chance to choose the sponsor that they are willing to work with, right? So for Kova, for Team Kova, right? I call it a team because our board directors, Pandu, Alvin, and our advisor Austin Russell, they are critical to how we view a successful transaction and how we can help the company grow, not only operationally, but also with their experience with capital markets, right? Does that make sense?
I would add to one other aspect. See, look, your question has two aspects. One is private markets and VCP funds versus public markets. And then within public markets, SPAC versus IPO. So I would say, look, SPAC, in fact, is so uniquely placed that it kind of combines the two. You have all the advantages of going public, but at the same time, you could pretty much do transaction as a private M&A. And that's the huge advantage. One, you can have upfront value discovery. That's one bigger ability to use projections, which are not allowed otherwise in a normal IPO. An opportunity to negotiate confidentially, and you select your partners. I think that's a huge advantage, June is saying. And finally, rapid execution as well. So it's a great combination of both, the private transaction as well as still access to public markets.
I mean, the only reason why I bring this up is because there's a lot of criticism around the role that SPAC sponsors play. I mean, first of all, there are two aspects, right? One is that the sponsors actually take up, a substantial amount of equity, leading to a lot of founder dilution for a SPAC compared to, say, IPO. And the fact that, a lot of these specs actually, when it comes to performance in the IPO market, actually has been pretty lackluster if you look at by historical standards, right? So the question then, is still down to the same question about, how much value do specs really bring to the table in that sense, if founders are still disincentivized, unless, you do think that things are changing these days. I mean, I don't know. The question still begs, right? Like how different are specs today compared to what it was before?
No, there are two things. Let me just say, first of all, I disagree with you. And let me humbly put forward to you, why do I disagree? In the past, the SPACs had a reputation of being empty shells or dirty shells sometimes, and poor businesses had a way to backdoor listing. And yes, to some extent, perhaps that criticism was correct. But a lot has changed ever since then. It is the quality of sponsors which is very important, and that has really changed quite a lot. Today, we are also living in a great time of tech-enabled businesses, which has really brought phenomenal number of companies which should potentially be public but haven't gained access to public market. And third is this particular feature of SPACs, wherein you could use your projections, which you can't do in an IPO, is a great one for particularly tech-enabled businesses where they can show clear paths to profitability while not being profitable today. That's one part. The second part where I disagree with you is that SPAC sponsors end up making a lot of money and is perhaps a lopsided business arrangement. First of all, as I mentioned, eventually a SPAC sponsor will get a low single-digit percentage of the asset. And if you are a value-add player who can clearly bring value, that thing gets paid up within a few minutes of transaction. But even if you look at total cost of transaction in a SPAC, even including advisor fees and all, it's still between 4 to 5%, which is pretty much in the same range as IPO, while having all the other advantages. So I generally believe that there is, if you are not a focused SPAC sponsor, if you do not bring strong value add, yes, that criticism will be right. And that is exactly based, is one single variable on which they'll be falling out. Successful franchises like Junhong and all, they bring phenomenal value to in their TMT space. We understand the consumer branded space, so we bring that value. And these kind of franchises will be very enduring, according to me. And those who are just trying to get on bandwagon, most likely will fall out.
Yeah. The other, sorry, I mean, a lot of that, again, a lot of criticism. I mean, the other one that I forgot to mention as well is that SPAC sponsors tend to have a tendency to, take the money and then, drop it and leave their companies after the merger is done. I mean, do the three of you actually have a commitment to post-merger to stick on with the investment for, I don't know, 5 years, 10 years post-merger?
Yeah, we have seen that happen, and I think it's not widespread, but it does happen. I think for Team Kova, we are long-term investors, and we don't see it as purely transactional. And it's part of our business combination. We see the right fit between the sponsor and company as highly critical in order to have a successful partnership. And we want to be long-term, trusted, and knowledgeable partners to the management, right? So it's fair to say that post-transaction, we would want to be there and ride through the cycles and really help management build through the cycle, right?
What kind of time frame do you foresee yourself sticking with these companies post-merger?
So I just point out to you our Lumina transaction. We've been 5 years in the company, shareholders in the company. For us, with the business combination, it's actually just a start. That's what we have always told our investors and we told the market, that our involvement with Lumina is a long journey, and we believe this is just the start. And I think for any of our businesses that we're targeting, it's it's hard to put a number, right? 10 years, but we are here for the long term, and we want to be able to help build a company.
Obviously, this is exactly what our approach as well is. Anything we are going in, we have to have a mid to long-term story. You can't be there, because if you're trying to build an Asia bridge, you need to get the company ready first. You can't do it in 1 year. It happens over a number of years. And this is very good aspect that you brought out. Sponsors who go with a very short-term approach, again, would perhaps bring a wrong name to this pristine asset class. And I genuinely believe it has become a pristine asset class from what the so-called poor or dirty asset class it was. A lot of credit goes to a guy in your arena, Junhong, Chamat Palehapitiya. He's the one who's done 7 SPACs, who's already done 4 combinations. And then again, he kind of reinvented this as a path for high growth tech businesses to go public. And then again, I believe today there are at least about 10,000 companies globally that could be public and should be public. And SPAC is a fantastic route for many of them, particularly when you can demonstrate path to profitability while not being profitable today. That's one. But also, I genuinely believe many profitable companies and solid franchises would also come through SPAC to the market, because the advantage I mentioned of everything of public market, but also of the private transaction. So your criticism is right, that if you're not mid to long-term focused, then that criticism will be well-founded. Similarly, if you're not sector-focused and value-add player, the criticism will be well-founded. Otherwise not.
So what kind of advice would you give to a founder then who, may be on the receiving end of all these criticisms about SPACs and the track record that they're seeing on SPACs and the things that SPAC sponsors can potentially do? What do the three of you as SPAC sponsors do to ensure that, these target companies feel assured that you are not going to basically dump and leave them in post-merger?
Yeah, actually, can I, first of all, I'm not a SPAC sponsor. I'm just an advisor, right? So I actually look at it more from the perspective of the company, because I think I do have companies that, may consider SPACs as opposed to an IPO. And so I see it as just another financing vehicle. So there's pros and cons of different financing vehicles, which I hope they are aware of. So I tell them, you know, you can consider IPO. Yeah, that's definitely, you know, a very good route. You get time to, you know, do your road shows and educate the market. Maybe you get analyst coverage. And then, you know, but at the same time, why don't you consider SPACs? Because like you said, there's so many SPACs out there. You can probably negotiate, you know, good terms. Maybe you can lower the, you know, the percentage that the sponsor gets. But at the same time, there's certain advantages to SPACs, right? One is speed, you know, the other is like Ravi mentioned, you know, you get to give projections, right? And you get to negotiate the price. So, you know, unlike a lot of the recent IPOs where a lot of money was left on the table, you might have, you know, more certainty about the valuation. And I think that a lot of very credible companies have recently gone through the SPAC route, right? And if you see the reasons that they listed was that, you know, besides the ones that I mentioned, maybe, you know, their business model is a bit complicated. They wanted more like private time with these select investors to explain their business models. So there's definitely advantages to SPACs. And then, you know, at the same time, you know, there are companies that feel that I don't need these sponsors, I don't need the value add, I can do it on my own. Then I say, go ahead. There's nothing, you know, that is like the SPAC gives you a lot that is not given through an IPO. At the end of the day, it's about the company. How good are the quality of the earnings? How good the quality of the whole operations, right? So I just say to them, you know, it's just an alternative that you should understand the pros and cons. The con, of course, is that, you know, there may be more dilution, but I remind them that, you know, going public, a lot of companies, a lot of founders underestimate what it takes to go public, what it means to be a public listed company. I tell them it's like almost like getting married. It's once in a life, or maybe at most twice in your life that you're going to do this, right? So you have to get prepared. Are you ready for, you know, this meeting investors, right? Shareholders. Are you ready to have quarterly projections? Maybe, you know, you need help. You need, you know, a whole team of people to help you with all these, you know, what it means to be a public company. And if you feel like you're not, a lot of founders are not geared towards making this kind of change. Like they're still in the founder stage where they are just running so hard and, you know, running so fast, right? With the operations, with the company, that they are quite happy to, you know, in a way, have somebody help them, help somebody navigate, you know, through this process. And maybe, you know, they just need it for this SPAC or IPO process. And after that, they don't need that person anymore. I think it really depends on the company. But I think having, you know, an experienced mentor, experienced coach next to you, it could really help even post IPO. Yeah, so it really depends on the company.
So double clicking on what Helen has said, first of all, she made a very good point that there will always be a market for private VC or private growth equity. There'll be great market for IPOs. And there'll be market for SPACs. But what Helen said earlier on, that there is a lot of money supply at very low interest rates that is fueling a lot of these things today. So as somebody said, when wind is blowing very well, even a turkey can fly. You make out eagles from Turkey when wind is not blowing. And I think that is where the eagle and turkey situation here is the guys with real operating edge and the guys not having the operating edge. I genuinely believe that platforms like Junhong's, they would go on to do not only one great transaction, but repeat transaction with very successful outcomes. And those who are just trying to get on to this wind blowing well phenomena may not perhaps do. So this falling out has happened in both private markets and general public market. There will be some crappy deals, but so will be some crappy IPOs.
So next question for June. I mean, you're based in Silicon Valley. I mean, why target Southeast Asian deals when you've got plenty of US top quality deals in your backyard?
Yeah, great. It really comes down to having the right team and having the confidence to execute globally. We're excited to, you know, to have Crescent Cove partner together with Pandu and Alvin, and of course, Austin, right? All will be able to bring different technology investing and operational skill sets. But last but not least, you know, critical local regional experience to the table.
Yeah, but why Southeast Asia? Why not other markets, China, India?
There's a lot to do with our directors. And I had a long-term relationship with you know, I've known Pandu for many, many years. And, you know, we have confidence of the partnership of working together and having a successful business combination, right? We are very focused on areas where we have an edge and have the ability to execute, right? You know, we are being focused that way by not going to the areas where we do not feel that we can execute.
So you don't think you can execute in the US?
No, we do actually have the ability to look at the US, but our focus is in Southeast Asia.
Okay. Yeah, maybe next question for Helen. I mean, we haven't really seen that much SPAC buzz in China. I think like before we started, I think you did share a little bit about this as well. I mean, could you give us a sense in terms of how the Chinese market looks like SPACs these days? And is there a reason why Southeast Asia seems to be jumping ahead of the curve, ahead of China or even markets like India these days?
Yeah, I think the wave of SPACs really came from the US, and given that, you know, there's so many, so there's now, you know, looking for targets globally is the trend. And I think Southeast Asia is probably a little easier for, you know, US investors, I think, to target than China. China has very much, for a very long time, been a closed ecosystem. And the other, I think, reason is that, you know, China has had the phenomenal IPO markets, right, locally. You know, I always tell Chinese companies how fortunate they are because they can choose between, you know, the Asia market, the Hong Kong Stock Exchange, and NASDAQ, right, on NYSE. So that there's so many, you know, there were 400 companies that went public last year, if I'm not wrong. So, you know, in China, so there hasn't been a need to look for a alternative vehicle, right? Whereas I think in Southeast Asia, there's not been so many. That's why I think sponsors, you know, could really help the process. So I think the other reason, you know, which we talked about is also that there haven't been so many sponsors coming out from China. So you see, you know, very, you know, new vehicles like Primavera, you see the, you know, Honey coming out. So I think as more of these, you know, private equity type sponsors come forward, then maybe, you know, you would see some of these companies maybe selecting SPACs as well.
Yeah, I mean, how much of it is a reputational issue? Like, how do Chinese perceive SPACs? I mean, number one is is it a reputation aspect of it that, you know, that has led to this slight delay? And second also is, I mean, from my understanding, I think Chinese market would have a way more growth stage capital compared to a market like Southeast Asia. Could that be one of the reasons why, you know, there are more options on the table, so therefore perhaps SPACs might be, you know, something I would consider, you know, down the list, so to speak.
You see, I would disagree with that, and Helen, you please then add. But basically, it is simply a regulatory issue. I think the only other market that, beside US, that has taken up SPACs well is Amsterdam. Even London, which is a robust exchange, or Tokyo, others have not taken on. It is purely a regulatory issue. And I'm very excited that SGX is considering this alternative. And I genuinely believe many Asian companies could find a great path, could tell the same story like US companies are able to tell in US market. But the governments have to decide and the exchanges have to decide whether they allow to use future projections. And I think that's the single variable. Singapore had considered it in the past, at that time passed it. I hope this time they would consider it. So that is the real issue. Otherwise, in China, of course, it's right that once you get listed, valuations are incredible. They're far better valuations than you get in Hong Kong market or other market. But the path to listing in China is onerous too. The whole process with CSRC is fairly long. The queue is very long. The process is very intense. But I would say, yes, if regulatory environment changes, I think Asia could take off as much on SPAC market.
Yeah, I mean, I guess you're talking about, you know, exchanges allowing SPACs to list, but here in Asia, we've actually seen 2 Asian markets that have allowed SPACs in the past, and still do, Malaysia as well as South Korea. But in both cases, apparently, again, back to the reputational issue, when you look at the track record on both markets, it hasn't really been that great.
But again, I said, even in US, by the way, in the SPAC, reputation was not that great. So we dealt with that question earlier, that the poor and dirty reputation of SPACs or backdoor listing reputation of SPACs was perhaps rightly placed in the past. Today, what has changed is the quality of sponsors. The quality of sponsors that are coming out, the targeted approach that the folk is taking is very different. And I think also technology-enabled companies, which might not be profitable today, but have a clear path to profitability, they can use projections to reflect that to market. I think that is the key differentiator. And that is why a player like Chamath with Social Capital came out with, he was a real pioneer, and now done already 7. I think there'll be many more Chamaths will appear. I'm looking forward to Jun Hong's next foray, and others in the market, I genuinely believe would come out with very, very strong franchises in SPAC.
Sorry, Helen, you got cut off, so I just want to make sure you get to finish what you wanted to say.
Yeah, I think Southeast Asian companies just, most of them don't have the scale to go public, right? I think you have, 6 unicorns in the region, and I think those would be the main targets of SPACs, right? And like, I think they are probably at a stage where they can consider IPO or SPAC. So against, why SPAC, I think it's really about the sponsor, right? Whether they can add value. I think in China, you have, a lot more companies of scale and companies that have the ability to go public on their own. So you're talking not just about, the companies themselves, but also like the service providers, right? Your whole audit team, your whole, legal firms, at the bankers that are covering China. So, that whole, how do you say, to deal with the corporate governance and the whole public, being a public company, that setup is so mature. So that's, I think when I talk to companies in China, about SPACs, the first question is, why do I want to be diluted, right? With the sponsor So I think, that's really the first thing they have to overcome. Then the second thing maybe is a bit of, there hasn't been that many great SPACs. So, I mean, for example, I think your work went public is like the WeWork of China. So, I think that story is a bit, I mean, I like the founder of WeWork, but I think, the story is not as strong in a way, right? Because of the WeWork debacle. So they feel like SPAC could be a way for them to, it could be a better alternative than an IPO. But that's not a great, SPAC to open the door for China's companies, Chinese companies. So that's also, I think it would take like, maybe a successful story, and then, the market will get more and more educated about SPACs.
Yeah, just kind of keeping with that line of thought, right? Like, Helen, you've seen several IPOs like in China. I mean, and you've been in Southeast Asia, you've seen a couple of deals in this part of the world as well. I just wanted your take in terms of how you see the deal quality compare in Southeast Asia versus what you've seen in China, as opposed, I mean, in terms of being exit ready, IPO ready, are we there yet?
I think, definitely it's at a much more nascent stage, right? Southeast Asia is, in general, only became exciting maybe 5 years ago. I mean, in terms of the, companies that would be able to benefit from the growth, right, in the internet. So in terms of the, the scale, I think some of them are reaching the scale in terms of the, their ability to be a public company and be able to, offer quality projections. I think that there is a lot of infrastructure that needs to be built up. And I do think that, you're going to see this year as being a very exciting year. The future years would, see the ecosystem grow.
Sorry, June, I think I cut you off earlier as well. I don't know if you can, was there something you wanted to chime in?
Yeah, no, I just wanted to add on to what Ravi said about the vehicles. About Amsterdam listing, and London's looking at it, and SGX is looking at it. And to your point about Korea and Malaysia, kind of blank check vehicles, right? So at the end of the day, the SPAC is a blank pool vehicle, right? It's a blank check vehicle. What's critical for regulators is to ensure that there's consistency across the vehicles and ensure there's transparency and governance, right? And post that, it's really free market, right? A good sponsor can probably bring a good company on the back end, right, and create a successful business combination, right? But on the front end, what the regulators really, if they really decide whether to do it, it's pretty straightforward, right? And it's great that SGX is thinking about it, because yes, it would help the liquidity in, to Helen's point, some of the companies are smaller, but that doesn't mean that they cannot have something, right? Each market will have its own local flavor if they want to do this, but from a regulatory standpoint, straightforward. And if you have good sponsors, they will make it work, right? Something will work.
Back to you, Ravi and Helen. Since we're touching on the topic about SGX, planning to allow SPACs in Singapore. What's the likelihood of that happening, do you think?
Steve, there are two aspects. One, Jun and I spoke earlier about the regulatory environment. If the government and then exchanges allow that, I think that would be very welcome. And I think it's a very exciting development that SGX is considering it. We would love to participate if that happens. But there are two other aspects. So today, US and let's say Canada, or let's say New York, Toronto corridor has very strong set of hedge funds as well as then mutual funds. So on why these two, the ecosystem of these is very important. In Asia, we need institutions in that play to also help. So what happens is typically hedge fund guys would invest in your SPAC when you're raising, and eventually long-term play, mutual funds and other long-term plays will take over. And that is where names like Fidelity, T. Rowe Price, Discover, Edgevora, Monashi, Polar, Millennium, all these are big institutions who have been playing this for a long time. So I think in Asia, it will be also a matter of time. It can't be put the switch on and next day it will start getting. US has much more experience. You have these both hedge fund and mutual fund great experience of playing in SPAC market. I think it would be getting started and staying on course with it, and then really supporting initially with all institutional help. And I think if we do that, it can very much be done. I genuinely believe there are at least 1,000 companies in Asian territory which could be and should be public. And the second point I would want to clarify, because this point has been raised quite a few times, too much dilution. I think it's important to understand the mathematics of it. So first thing is those viewers who are considering to launch a SPAC, I think what size of SPAC you launch is very important. So first of all, if you're looking at US market today, which is the most fertile market where you can go, if you go below 100 million or below 150 million, it becomes a challenge because, anything below $1 billion valuation becomes micro cap. There is very little attention, forget New York Stock Exchange, but even in NASDAQ. So you're looking at $1 billion plus assets. So it's not enough of meat in that. On the other hand, if you take 250, 300 million, then people believe, hey, could it lead to too much dilution? It would not if you're looking at 5 to 8 times the size of your SPAC. Because if it is 8 times, so you get 20% of your SPAC size as a promote. And then if you're 8 times, you come down to only 2% of the asset. And I think 2% of the asset is not too much dilution. If you're a value-add player, it gets paid out in no time. So that mathematics is very important to play. So right sizing of SPAC is important if you want to play US market, and then focus on the value add.
Okay. Last question before we go to Q&A. Again, for Ravi, most SPACs are focused on technology, but what about non-tech companies, which is what you focus on? Do you see a lot of great businesses there that are not listed both in Asia and Europe?
Absolutely. Look, in our first round when we went out, we looked at a few dozen companies, and we had 12 companies that we had shortlisted. And I could tell 10 out of those 12 were non-technology companies. In our second SPAC that we've just launched, also called same Aspirational Consumer Lifestyle SPAC 2, I believe very likely that we will bring a consumer brand from the traditional segment, but with great tailwind behind it. And that kind of business would be as good as a technology business that we brought. And Wheels Up was a good combination of consumer brand as well as having technology backup. But I think quite likely our second SPAC will bring a pure consumer asset to the market.
Yes, one audience question, since you spoke about Wheels Up earlier. This question was for you, Ravi. How much of the promote if any, did you guys need to forfeit on the Wheels Up deal?
Well, good thing for us. That's a very good question. Again, and most of the viewers need to look at that as well. Quality of a good SPAC is seen from, did you have to give any discount? We gave 0. Did all the shareholders, existing shareholders, Wheels Up, roll in and not sell out? Again, 100% came in. Did you guys who came in your aspirational stay on with you? As of now, 100% indicated they're staying on. And then finally, the quality of pipe investors. So we not only put $240 million from our SPAC, we raised $550 million of additional pipe investment, and the quality of investor, Fidelity, Templeton, T. Rowe Price, these are big names. They're long players, and that way, I generally believe Wheels Up scored 100% on all parameters. And this is important. If you have the right play, you would get that treatment. If you do not have the right play, you'll either end up paying too much valuation, and that's the only way you can attract somebody to you, or you'll end up giving discount, which is finally not the right play.
Next question is, we're going straight into Q&A right now. So we've got questions for all panelists. This is from Sarat Bhutani. How do you see appetite from pipe investors for Southeast Asian assets? Will this be a bottleneck? And do you see Asian investors investing in pipes following GIC's pipe in the viewing? Any takers?
Sorry, can you please repeat the question? I was distracted for a moment. Yeah.
No worries. How do you see appetite from pipe investors for Southeast Asian assets? Will this be a bottleneck?
I think Helen touched on this point earlier very well. The issue in Southeast Asia is the size of assets, that we are a little bit undersized or underscaled, and not many companies have the right kind of scale. And I'm happy that Junhong and all looking at Indonesia, because at least that market has some good scaled asset. Singapore has some rightly scaled asset. I think that's the only challenge about the market. Whereas why China, India, which you mentioned as well, because assets have scaled up fairly fast. So do we have billion or multiple $1 billion valuation assets in Southeast Asia? There are maybe a dozen, which we can easily think of. But and therefore that will be the constraint, I would say.
Yeah, to add on to that, in regards to whether there'll be pipe investors for certain assets, I think that really comes down to whether the asset is attractively priced, and whether it's whether it is value in the asset. If it's an attractive asset, there will be players for the pipe. It's not, there's no secret to it.
Jun, thank you for taking that up. I missed that piece. And it is true that if quality of asset is great, like in Wheels Up, we planned to raise 300 and we upped the pipe itself to 550. It's all about quality of asset. Junhong, thank you for taking that up.
Yeah, I think there's no shortage of, big funds in Singapore, right? I mean, the Wellingtons of the world and or here, and Singapore government has been encouraging a lot of the fund managers to move to Singapore. And then the other trend that we see is the high net worth, right? The family offices moving to Singapore. I think Sergey Brin just announced he's opening his family office. So I think that pipe investors, there shouldn't be a shortage as long as there are good targets, like my fellow panelists pointed out.
Okay. Next question is for June. This is from Sam from Vina Capital Ventures. His question is, what lessons can we learn from the SPACs environment in the US that can be applied to the Southeast Asian market?
I think it's a little bit different, the market in US versus Southeast Asia. For Southeast Asia, we have not seen a transaction yet. But in the US, the market is larger, right? Rightly pointed out by some of our fellow panelists. And Southeast Asia market is smaller. So the ways we approach the target, of course, has to be slightly different, right? So other than just capital, there's also the element of local experience and geographic expertise. So I think it's compared to the US market, there's a much bigger difference. US, it's really fast, and it's like a free for all. And again, Asia and Southeast Asia it takes a little bit longer for the target companies to actually get comfortable.
Okay. Next question, I think can go out to all three of you actually. This is from Nirav Shah. His question is on India. What is the view on interest of SPACs for companies based in India? There are so many unicorns which have raised huge money from global investors, unique technology, and huge market potential. And what are the challenges in terms of Indian regulations and laws for SPAC listing?
So, well, India, as of now, is a fairly robust capital market for IPOs. And a lot of companies at a fairly young stage go public in India. In fact, this is one market where assets do go public far earlier than any other market overall. But there is a clear play in an India-US corridor. Like in the last 30 years, China-US corridor became a great corridor for manufactured goods. China was a great manufacturing economy, and that corridor created hundreds of billions of dollars and multiple $1 trillion, in fact. In case of information technology, I think there is a great US-India corridor. There are a lot of companies which have Indian costs and US revenues and have built a very robust model in technology, SaaS-based platforms and many others. And I think a lot of those should be good targets for SPACs.
Anyone else wants to take
I
that?
understand. Yeah, I understand. There have been some regulatory, restrictions that you have to have like BRI and you have to have the relevant ministry approvers. Maybe that's why you haven't seen so many SPACs. But I did see that growthers might be trying for a SPAC, so SPAC listing. So that could be something that we would see more of in the future.
Wow, we have so many questions. Okay, this one is can go out to all three of you since all of you are involved in SPACs. This is from Tom Heron. Could you share the prevalence of earnout structures to align sponsors with the operating company? How flexible is the negotiation?
But this part is exactly same as whether in private transaction or even public transactions. This is all depends on typical negotiation in any deal. So absolutely, there is a good quality management needs to be incentivized in a strong way. And therefore, I think one would always recommend to have a solid incentive system in place, whether through earnout or whether through ESOPs, whatever system you want to put.
Yep.
Go on.
Yeah, so just to point, just to add to what Ravi said, even we completed our transaction for Lumina Technologies. We did have an earnout structure there. It's public information. It's about 7.5%, and it had different hurdles in regards to the share price to help us help the management or original shareholders reach those targets. But it was a way for us to deal with any perceived potential perceived dilution on the cost, but it's as Ravi mentioned, it really comes down to a negotiation with the sponsor. The sponsor.
Another follow-up question from same person, Tom Heron. Are SPAC sponsors effectively seeking to replace iBanker's IPO fee that companies would pay to get listed? And the other question that he had also along the same lines is there any valuation discount by Pipes when looking at the operating company between traditional IPO and a SPAC listing? You want to take this, June?
Go ahead, John.
No, Ravi, please.
Okay, I can take the first part, and then maybe John and Helen can add to the second part. I don't think there is any replacing iBankers. I think this is a complete coexistence, and it needs all players. So today, most of the SPAC sponsors have worked with Credit Suisse or Citi or JP Morgan or Goldman Sachs. So Morgan Stanley, etc. All of them are a player in that while raising your SPAC. Similarly, when it comes down to eventual PIPE, again, you typically have been working with various bankers who work together with you. So I think it is an ecosystem wherein everybody can pitch in and add value. Similarly, whether you're doing diligence in this format or in a private format, you have similar diligence costs and all those things where, again, those intermediaries are able to help. So I think this successful build of this asset class would need everybody in the ecosystem to play, be it the bankers, be it hedge fund, be it mutual funds, be it the stock exchanges. And I think that ecosystem needs to arrive in Asia in completeness as well. And I hope it would. And when it comes, we would love to participate in that.
Yeah, I agree, Ravi. It is not to replace bankers. I think it really gives companies another option to be publicly listed, right? It's there's the IPO, there's direct listing, and of course now there's SPACs, right? It's not one path will be the right path, or maybe all three paths are the right paths, but it gives companies and management the ability to choose what works best for them. I think that's probably the right way to look at it.
Yeah, I think one thing is, the bank, the sponsors do put up capital up front that covers some of the banker fees, and that is at risk if the SPAC doesn't work. If it eventually fails, that money is gone, right? So, but I don't think of that as a replacement. I do think that the sponsors probably lend a lot more credibility to the IPO story, so that the bankers are still assisting in the process.
Okay, one more question from Jayesh Nair from Telenor. This is again for all three of you. Two questions. First is there a valuation sweet spot that companies should consider for the SPAC route? And the second is any indication or trends that you see in new SPAC issuances, say more from Asia or more from consumer or SaaS companies, or more interest from large institutional investors?
Yeah, let me take that for the size of the company. I think it's important to note that with the listing, there are actually increased D&O costs and listing costs, right? And being private allows you to not incur those expenses, right? So with that cost alone, which has gone up drastically in the past 6 months to a year, there is a certain barrier on how big the company should be, right? So in the US, the kind of natural kind of barriers around like $1 billion pre-transaction value. And I think the sweet spot would be for what we do, what we have told investors, so what's the right number is between 1 to 5 billion. That's where we believe we can add the most value. Once again, it can be different for different sponsors. We just prefer to be that range, and we want to be highly focused, right?
I would agree with Jun Hong, and this is what I said earlier as well. Anything below billion becomes really a micro cap play for US markets, and that would not get the right attention from all the players in ecosystem. Valuation, on the other hand, is a question that is sector specific. Certain sectors are evaluated on revenue multiple, certain are EBITDA multiple. It is all based on what sector within the whole SPAC market you're after, and that will perhaps define the valuation play. But I would 100% agree with Jun Hong.
Yeah, I think in terms of trends, it seems like EV is still very hot. It seems like more and more EV companies are going the SPAC route. And I think that, there seems to be more and more celebrities joining. And then, some questions being raised about how fit are they to really, help the companies. But I guess, it's really, as you get more and more SPACs being raised, you will see a big diversity in both the sponsors as well as the sectors that the targets are coming from.
One more question from Stephen. I guess this can go to all three again. How are LPs in Asia, especially Southeast Asia, looking at SPACs in terms of the investment structure?
Okay, this is the step. So LPs, limited partners, how are they looking at it? Well, I didn't think of it because LPs typically, again, it depends on LPs or what. LPs in venture, or LPs in private equity, or limited partners in other play. Many of the LPs, particularly if you're a private equity platform, they do not want you defocused. They want you to be fully focused on a private equity platform, and they think sometimes this could lead to defocus. And they would expect you to have a separate dedicated teams if you are going for a SPAC vertical, and then you do that. As far as LPs wanting to play, there are a lot of LPs approaching various successful SPAC sponsors to participate in the sponsor group. I think there is a genuine interest from them on that as well. And I think it could only get wider. Particularly the bigger names, of course, are already in play one way or the other, either maybe not in sponsor groups so much, but in the pipe segment. So that's where I would say, I think all the major players would eventually look at PIPE or once you get listed. A lot of them do play in public markets very well. They are observing these SPAC vehicles and see which ones are high quality and which one they should back when it comes to public markets. I think at various levels of play, there is a different degree of involvement.
Helen?
I think it's pretty much covered. Yeah.
Okay. Let's take a look. Hold on a minute. One question here from Nigel. Does the SPAC make more sense to companies that don't need to have a to-market to consumer branding? The IPO route requires a company to have the brand marketed to the investor and public community that is challenging. SPACs allow the companies to leverage the sponsor's reputation to do this?
It's a very good question. And I would say to some extent, yes, you could leverage sponsor's reputation, but to some extent only. Eventually, even for sponsor, it's very important, the quality of asset, the quality of the brand, quality of the business. And typically, if you're taking an Asian asset to US market, look, typical US investor would want to invest in something they know, they've heard of, they know the category, they can feel tailwinds in that category, they can see the runway, and then therefore total addressable market, all these variables. If you're able to tell a succinct story about all that, yes, that can play, and sponsors can be very helpful in that part. And this is where the beauty of this versus even direct listing or IPO, that you're able to select your investors, select your sponsor group, which is huge on that part. And look, an upfront value discovery is also a very unique part, but you're right, the storytelling part, right sponsor can absolutely help.
Yeah, what I would add is, once again, the SPAC vehicle is not a magic bullet. You need a good asset, great management, and companies that are IPO ready to actually have a successful transaction and post that, right? It's not a magic bullet. If you have not figured out your product market fit, you do not have a clear path to break even. Yeah, it's a short-term fix, but it's the SPAC listing is probably not the right move.
And by the way, with SPAC listing or normal listing, listing is just a beginning, not a destination. And that is a very important point. And if you have a clear path to justify you being listed, justify you staying in the market with a real growth story, and then strong quality of brand management and business management we have, I think we play in both markets equally well.
One more question for all three. This is from Gan Fong Jik. His question is, what would you advise aspiring sponsors who want to raise a SPAC? What are the risks sponsors should look out for?
Janhong, you want to go?
Sure. So I would say, of course, there is the risk capital. Things keep changing there. The D&O insurance has gone up a lot. You're looking at a negative carry. So I would say, ensure you have enough financial backing to cover the SPAC operating expenses. But post that, ensure that you do have, the focus is clear, right? What kind of businesses you're trying to look at? What type of what value add is your board going to bring? What investing experience can they bring, and what operational experience, what operational background are you going to be able to add to the company? I think these are very basic questions that any aspiring sponsor should ask themselves.
I would simply say that the biggest risk is the reputational risk. If you go out there, you've got to be sure that you have all the elements in place. Risk capital is the basic requirement at the very first to be able to do. But do not underestimate the work required to get a successful combination done. It is very intense amount of work. And if you happen to be located in Asia, you pretty much have to start living the New York timing because all the roadshows happen with US timing, all the pipe discussions happen with the timing. If assets are there, then that. So it is a fairly intense amount of work. And we've done fairly large transactions as well, but now with the public market orientation, with all the SEC filings and all the regulatory issues around, it is fairly intense. So one, be ready for it. Secondly, have dedicated team. Do not try to combine it with your PE platform or other things. Have a very dedicated team. And third, of course, as Junhong said, the cost part, make sure that it's not just the risk capital, because sometimes it could take much longer to find right assets. And sometimes transactions, you may do diligence and finally you may drop it. And same thing like about costs in private equity world could be added to that. So you have to be ready for all of that. And D&O insurance, as Junhong said, it just lasts 6 months. It is multiplied 3 times. Yeah. Perhaps it is because there is too much market, so therefore guys think, why not? But also maybe complexity has increased. So just go and dive in when you have complete ability on all these fronts. Risk capital, be aware of other costs, which could be fairly high as well, and a dedicated team, and they can live the night shifts.
Okay, we're really running out of time, so I have to keep it to 2 questions, so let's keep it tight, yeah? This question is from Li Jiawei. Is there any conflict of interest in a PE-sponsored SPAC for their portfolio companies?
Helen, you want to take?
Yeah, I think definitely. I mean, if you're actually targeting your own portfolio company, you do have to be aware that this could be a red flag for the SEC, and that's one thing that VC or private equity firms should consider. I think it makes more sense for you to target something that's probably not your portfolio company, but I think. Given that PE and VCs are in the business of doing these kind of investments, and hoping to exit them through an IPO, I think there should be enough targets that they could go after, and they probably have a target in mind when they do these SPACs already. So yeah, I think that they should try to avoid the conflict of interest issue.
Like having gone through one SPAC to the combination and having had a private equity platform as a backer in it, I can tell you that it does bring a lot of complexity, both ways. One, a private equity firm is just in the sponsor, even if they're not bringing their own asset to the market, already you need to give full declaration that your fiduciary duty is to private equity fund, where you'll take asset first, then it brings a conflict of interest, and it makes it fairly complex. So you will have to do additional disclosures. You have to live to those disclosures with full moral responsibility towards those. And finally, if you end up considering an asset that is in your portfolio, that brings the complexity to 5x of that one. And I think I would say, again, in our case, we did have L Catterton as one of the sponsors, as a minority sponsor. But in the second SPAC, we have taken that, we're going as individuals, because bringing those two together does bring high level of complexity. That doesn't mean it cannot be done. There are a lot of PE platforms which have launched this SPAC platform, and they will get it done. But I would say it will require dedicated team, dedicated focus, and not mixing the two things too much.
Okay, absolute last question, because we are definitely overrunning. This is from John Young, and this goes out to all 3. Would the panelists like to speculate the percentage success rate of an actual combination, SPAC combination, I mean?
Sorry, is that speculate on the future success rate or the historical
for the
okay.
success rate of a SPAC combining, a SPAC merger happening.
For individual or for the market?
Or for yourself.
Okay. Go ahead, guys. We were lucky, by the way, to be able to go to the market within 4 months, be able to bring combination. Look, about 90 plus SPACs got raised from Asia last year. This year already, almost the same number have already been raised. Whereas it comes to bringing combination, the number is just about a dozen plus. So yes, the key issue is de-SPACing, key issue is bringing combination alive. Now, again, my message to everyone is, guys, be sector focused, have dedicated team, have a clear value add play. If you are Asian based, look at asset where you can build a bridge to Asia if it is not an Asian asset, if those things are very clear, I'm sure you'll be a great attraction to both the investors in SPAC as well as the founders and CEOs. And if you do that, your success rate will be very high.
Yeah, I would say I have quite high confidence that the Catcha SPAC will succeed. Otherwise, I wouldn't be the advisor. I think, there is increasing interest in the region, in Southeast Asia. I think there are companies that are ready. So yeah, I think if we are able to execute well, we should be able to have a successful SPAC. Yeah.
Oh, Jun.
Yeah, I guess, for Kova's point of view is, we like to earn the ability to close the deal and have a successful business kind of transaction. But, we'll, in the meantime, we'll be diligent, we'll try and find the right fit. At the end of the day, it's really finding the right company and having trusted and knowledgeable long-term partners. I think that's the most critical part for us.
Cool. We've come to the end of our webinar. Thank you so much for staying with us. Before you go though, I've got one final plug I need to make to all of our special viewers out there. We are having a 7-day trial subscription promotion to exclusive stories and deals on Deal Street Asia, and it's going for $14.14. So there's a QR code, which I'm sure you can see there on the screen, which you can access for further details. If you have any questions, we will be sending an email separately post this webinar. And if any other questions, please reach out to us and we'll be happy to take them for you. So thank you, everyone. We've come to the end of the webinar. I hope to see all of you again soon. Thank you to my panelists for joining us today. It was really, really insightful. And I hope to see all of you again soon.
Thank you, Christy.
Take care, everyone.
Thank you. Thank you. Bye.
Bye. Are we off?